Welcome to Kaplan, to the CAIA seminar. My name's Thomas. I'll be teaching the level 1 and level 2. So quick thing about me, I was accounting background and then I switched to finance after my master. It was great fun doing finance. Financially it's pretty lucrative as well. And then I do my doctoral. Now I teach at various places. For AI, being here, it's actually a very good choice because the industry had grown quite a bit. Main thing would be if you look back 10 years ago, it would be really just private person or hedge funds doing it. But over the last 10 years, we have insurance buying it. Even pension funds now can buy many of the hedge funds or AI products. So the market and demand for it is much higher, both supply demand side as well. In terms of how useful this is, if you look at regular finance, you have the CFA as your hurdle or your mark of distinction. For AI, CAIA is the only one that focuses on that. So like CFA's programs AI section, we focus on what they actually do, how they do it, what they use to do it. So it's a very, very focused and in-depth program on AI itself. So when you look at the industry right now, they have many luncheons that they held all the time. So when you go and you talk to new members or those that are taking the exam, most find it very useful. CFA hasn't done something similar, but I'm sure the CAIA program is much higher. In terms of a career-wise, when we look at people that came for the program, many of them do it for several purposes. Main one is if they're not the manager themselves, they are the one that either do risk management or planning and so on. So they need to have the knowledge to support properly. So they find it very helpful in that case. For those that are actually doing it, for AI it's very specific. So it's not a learnable knowledge. So they do it by learning and some special skill, but for these traders or the managers, they use this more for career advancement. So they are running a pretty big fund. Now they're being the managing director or managing manager. They need credentials to move up. So that's when many of the actual traders found this useful as well. For marketability, it's very well known now inside the industry. When we go to luncheons or the functions of CAIA, there's very many high-power actual managers running it. So it's not like CFA where it's many students doing it. So overall, it's very useful. Here, I don't think it shows, but it's easy to get as well. If you do CFA, you're talking about, I guess, 2 years minimum, or 2.5 years minimum. Level 1, you do it, level 2 and 3, but here you can do it all in 1 year if you do, if you pass both times. For topics, let me flip through level 1 and 2s. So for topics, they have the professional standards. So this is the one they use the CFA book for that. So they adopted for CAIA purpose. For level 1, it's all multiple choice. So it's about 15 to 20% of the main topics. If I flip to level 2, they have the same professional standards. But for level 2 exam, they have 2 parts. The exam has 2 sessions. Level 1 is both multiple choice. For level 2, for the professional standards, it's a written question. You do it on a computer, so they give you the question. You have the 2 hours to type in the response. So for professional standard, it's purely written for level 2 in the case format. So you're given a story of someone do something or not do something, and you have to write what went wrong, why is it not correct, what he should have done, and how can you do to rectify if something had gone wrong. So it's a written format for level 2 in this case. The remaining parts, there are 5 major topics. So these are the 5. So when you look at how they test in level 1, it's multiple choice. The main topic are covered very broadly. So you learn everything about these 5 major topics in a very broad spectrum. So you have the 5 topics, and you learn pretty much everything there is, how they trade, the style they do, how they use leverage, etc., and risk management. For level 2, they changed the focus. So you have the same 5 topics: private equity, commodities, real asset, hedge funds, and structured products. So those are the derivative type credit products. For these, they ask in a focused, in-depth topic for each one. So for example, for private equity, level 1 will ask a range of questions. Level 2, you will have a very in-depth questions on how the fees are calculated, which is the major hard part for private equity. For hedge funds, level 1, you get your basic generic all style discuss how they do in level 1. In level 2, you have an in-focused focus on convertible bonds, how to price it. You actually have to do it all using a binomial tree. So different focus, with level 2 focusing on 1 or 2 major in-depth discussions on the questions. And then the other topics are pretty similarly weighted, 15-20% or so around. In level 2, there's one additional part they add in. It's more of, I mean, you're near the end of the program, you're more experienced now, so there's more on how to actually run the fund. There's some on risk management, how to calculate portfolio allocation, etc., using the AI-focused approach. So level 1 and 2 are basically focused on the 5 topics. Level 1 more broad brush, level 2 more focused in certain useful topics. In terms of study time, it really all depends. On average, the CAIA recommended hours are pretty accurate. So if you have average background, then it's about that. If you have a banking background like you do, it should be a lot less. Because level 1 is quantitative based, so many are your basic CAPM, your standard deviation calculations, your Sharpe ratio, and so on. So you would have done those already. So it should be lower, less time than that. For level 2, it depends on your finance background. So if you have done Black-Scholes, binomial tree before, this will be much easier and you'll take much less time. The other thing for taking Kaplan's CAIA course is that the standard time CAIA proposed is for you reading the text. For our notes, we focus on 2 things really. One is really what they test, because when you spread out all the topics on the table, they focus on certain parts of it a lot of times. So we focus on those as well. And then we focus on how to understand the question, how to understand the formula. Once you understand the formula, then everything seems easy. If you don't, then you can't memorize it. If you ask a different way, you don't know how to answer. So that will cut down your study time by quite a bit, by having you know what the formula means, what they do, in a much shorter period of time. For level 1, so earlier I mentioned it's all multiple choice, both sessions, heavy quantitative, many calculations in here, and then generic, very general knowledge, mainly descriptive, only some calculations. For level 2, then the second session is written on the computer, and you'll be given 3 questions, one on professional standards, the other 2 on the other 2 of the major 5 topics. In terms of fees, you have a enrollment fee. So that is fixed 400. You only pay once to join. After that, I think it's free lifetime. For the exam, we can still make the early bird. So November 12, it's in about 2 weeks' time, or 2.5 weeks' time, and you get $100 off from the exam registration. When you sign up, they go to a Pearson VUE website, and you're given the time period for the exam, and you have dates and time to pay. So let's say the exam period time is level 1, March 14 to 25. You'll be shown available sessions, and you pick the time, and you can change it anytime up to the date of the exam or the last day. So you're studying and you're ready, you don't want to wait, you can move it up. If you are busy at work, need more time to review, you can move it back. So it's very flexible that way. It's done in a independent place, Pearson VUE. So you go in, they do the military style, take all your IDs out, no rings, etc. You're given oil paper to do, and then everything is online. So it's pretty easy to do. You can flag your questions to go back to check, etc. So it's pretty easy to do. most students that did the exam found they do it with just about the right time. So they seldom not have enough time, but they seldom have too much time to spare. So it's a pretty even, pretty well allocated time for the exam. Important part for the pass rate. So it's actually pretty high. For level 1, the 60%, 70%, it's pretty normal given the level of knowledge it requires. So it's pretty encouraging for the pass rate. For level 2, it's relatively high compared to other programs. The reason is, in this case mainly, is when you get to level 2, the things they ask are just in-depth version of level 1 stuff. So for them, it's just more calculations, understand certain topics in more depth. So the pass rate is pretty high for CAIA for level 2. This might not apply to you. Hello. This may not apply to you, but some comments apply to anyone in the business. So here, if you have done this exam before and didn't pass, maybe work is too busy, then some will consider, should I do something else because I failed one time? But here, the industry growth is very high. If you look at finance, the market is very efficient now. If you go to regular banks or mutual funds, I mean, it's a good living. But the old days of you work hard, you play hard, and having fun will be probably a little bit past. Because now AI is where all the fun are. New products, competitive, new knowledge, new products, new advancements, all in AI. So it's where the fun is, where the growth is, or alternatively where the money is in a way. If you do take it again, then it's also better because you know where you're weak at. When they give you the results, you're given a general outline of your marks for the different topics. So you would know which one you need to do more work on. Another thing is CAIA don't provide lots of mock exam. It's pretty rare to find. If you sign up, you get one free one from CAIA. You can also buy one from them, so you can have 2 to practice on. But it's hard to find actual mock exam. So here, if you do our course here, you get one mock exam to do. We'll mark it for you and tell you the answers, and then we'll go through the way to do it, and you get a distribution of where you're weak at. We also, I'm jumping to her part, but we also have a very good question bank. So if you do the question bank, if you do the course, the question bank is very minimal amount extra. So it's very good buy. But with the question bank, there's, I think, over 1,400 questions in it. You can set up the question any way you like, random by the weight. It'll mark you, but based on the results, you can figure out where you're weak at, where you need to do more studying, and so on. So it's very useful in that sense. For us, we've been doing CAIA for quite some time. We're doing it in different places as well. We have programs in the US and UK. So in terms of keeping things up to date, we're pretty current on everything they do. I think Kaplan is one of the biggest provider of outside tuition for CAIA. So we tend to be pretty up to date on what they do, any new changes they might put forth. So that's our advantage in this. Back to the actual exam. Here it's a little bit jumping across the 2 levels. But in general, for the descriptive questions, you're just reading and understanding how it works. But for calculation, which is where most people are a little bit scary of, when you look at how they ask 2 ways. One is more mechanical. So you're given the numbers. If you know the formula, just plug it in and you calculate. So not difficult, but just mechanical. You get all the steps right, you get the perfect answer for sure. The other type they ask are more theoretical. So it's not a formula that's hard, but they ask indirect questions to test your knowledge if you understand the formula, how it works and why it works. So this is where we bring the value in, because this is how we teach the formula. This is this formula is used to measure certain things. First part is to measure what if this go up. Second part is for some other purpose. So for these type of questions, it will take a long time to understand yourself if you go through the formula and try to learn it on your own. So here, these two examples, binomial tree for convertible bonds are in level 2. So this is the major calculation for level 2. You use the binomial tree to price a convertible. For level 1, they do a CDS calculation. So if you want to buy a CDS from the bank, you use the same tree, but a simple one in level 1 to figure out what's the chance of default to price the CDS. So that is the two ways to calculate. This is just an example for the mechanical but tedious calculation. This applies to PE fee quite a bit because private equity fees has many special features in it because it takes a long time to finish. So here these are all the part of the major fees they might ask. Many of these are based on different amounts. So if you do commitment fee or management fee, it's based on the full amount committed regardless of how much is drawn down. Transaction fees, monitoring fees are each time the private equity buy one investment, they charge the firm that amount. But it's based on the total deal size. So it's including leverage. If they take the money and lever it out, then this transaction fee is based on the full amount, not your share of the equity. So another base for calculation. There's many offsets. So transaction fee offset against management fee for the year. There might be carryover. So just going through the steps can be quite a bit of work. So that is the mechanical version. For private equity, it's also hurdle rates and clawback to calculate. There's a waterfall where manager gets the fee first, client get the catch up later on. So there's pretty complex calculation. You go through the formula, do it a few times, and it should be okay. But this is the mechanical type we're looking at. The theoretical one would be on the binomial tree. So they might ask if the price of the asset go up, how will the gamma or the delta move? So it's really just testing if you know the formula, what it's measuring. If you know it, then it'll be so simple. It'll be a giveaway. If you don't know it, it's hard to figure out what they're asking. So these are the theoretical, look simple, but you have to understand the formula type question. So here we have two things we'll do for the demo. First is descriptive. So just going through what we do in class, but of course we only have certain minutes here. It'll be much shorter for here, but in class we'll do a little bit more. The main difference between we do it now and in class would be many things are common across different assets. So credit risk. Here in the demo, it'll be only discussing the 3 topics in credit risk. But for the actual course, we'll try to bring all 5 assets and discuss how they differ, because sometimes they ask that way. Credit risk, which one's exposed to credit risk? It can be private equity, hedge fund, and so you have to know across assets how they affect it as well. So those will be discussed in class, but not enough time in here. Second part will be the calculation and how to come to class and learn to answer questions even without studying. Okay, just common sense can get you through many questions. If you know the formula, if you know how they trade and how they make money. So here, this is the descriptive part. This is on credit risk. So level 1, CDS calculation, this is the introduction part. So credit risk, here they're defining like a bond type investment. You potentially is a bond fund manager, or you trade bonds for a living, and you have some worry about having the market going bad. So you want to buy CDS, you go to the bank, you call them, give me a quote. The guy quoting you need to go through this to give you a quote. So that is how they start doing this part. So when the guy is trying to give you a quote for the pricing, this is what he'll decide, right? Because here he'll first ask you, what do you want to protect? Do you want a default protection or a downgrade protection? Because a different price quote. Just like you buy health insurance, they ask, do you want full coverage or just certain type of disease? Different price quotes, right? So here, these are the different symptoms of the dying bonds. The worst one would be, or the easiest one would just credit spread risk. Market movement, even competitors' strategy change might cause any of these spread price, just regular price change. So this is hard to protect, like just a market movement. The second is a little bit worse. It's a downgrade risk. So if you have a rated bonds, S&P might come out and say, I'm downgrading this. Or if you're holding tons of Greece bonds and suddenly someone says, I'm downgrading it to junk minus, 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 you're in trouble. So this is a pure downgrade risk insurable by CDS. The last one, the worst, is the number one is default risk. So actually default not paying, going out of business. So these are the three levels, and you need to tell them for the pricing because it's different protection. For the CDS model, we have two different forms. One is structural model. So this is like you're being a stock analyst. You do the full model, cash flow, everything, but your focus is on the chance of default on cash flow instead of doing a valuation for the firm. Reduced form is the other way. When you do the structural model, you assume from your own experience. So you put in your own numbers to predict the cash flow, and you might get a different price than the market price, but you assume you're correct. For the reduced form, it's the other way, like pricing options. I'm assuming market price is correct, and I plug it in and back out the chance of default. Right? So different approach. Here we do the reduced form only. Structural model we do, but not the full cash flow version, but just a few formulas along the structural model format. After this, this is where they diverge. For the reduced form, there are two formulas, very short to remember. For the structural model, we don't do the cash flow version because you can't do Excel in the exam, but in here we use the Black-Scholes pricing model. Right? For Black-Scholes, it's used to price options, but it can be structured to value a firm. So here we have the Black-Scholes pricing model to price a firm value. We're also using a Merton model, which is juggling around similar concept for the same approach. So we use the theoretical derivative version to price a firm instead of cash flow for the structural model. So here, these are just the descriptive types. There'll be a lot more in depth in the class. For the calculation, we won't do here, but here I'm trying to select these questions to show, just by coming to our course, we will give you the basic knowledge and common sense to get these questions without taking the course. Right, so here, this is the first one. I'll give you a little bit of time to read through it first and see which one is the right answer, and then we deductively get to the correct answer without going through the notes. Yeah. So A, B, and C, which one appears to be correct? In this case, we have real estate investment. So in our curriculum, the CAIA is focusing on if I buy a whole apartment building. So I buy a commercial apartment building and I receive rental income from it as an investment. So here is checking, I bought this real estate and I'm receiving rental income long term, and suddenly inflation went up. So who would benefit, right? So normally when inflation go up, it means price change very quickly, and based on these three criteria of the person holding it, which one will benefit? So here, a property with a long-term lease, so it's assuming I'm the owner of the building. I receive rent from the tenants, and if you look at my financials, this is my income, my revenue, right? I receive rent from it. So if you look at the rental contract, most are long-term, right? You sign a 1 year, 2 year, if it's commercial, 5 year, 10-year lease. So you would always have inflation adjustment in your contract, but it's based on normal expected inflation. If inflation shot up suddenly, then let's say you have a 5% inflation adjustment clause. Inflation actually 10%, 20%. So no matter how fast or maxed out you increase your rent for inflation, you never catch up, right? Because inflation go up higher and higher, your real money, real revenue don't catch up. So in this case, this one with the long-term lease cannot benefit because you're actually losing money, real purchasing power. For the next two, when you look at the way the cash flow is, A is an income for me if I own the apartment. B and C are about mortgages. So those are my cash flow out, my cost. So here I want to check if inflation go up, then if I have an adjustable rate mortgage, that means the floating rate go up as well. I'm paying my interest on the loan on the apartment building, so this will not benefit me because my interest payment go up as well. So this one will not benefit. So by default, C should be the correct answer, right? So here inflation go up, floating rate go up, my fixed rate loan is actually worth more because now I'm fixed at a lower rate from before inflation shot up. Second one is something on two topics have this. One is private equity, one is real estate. So for those two assets, the price is not very liquid. You don't get actual real life pricing for these two. So in both topics, they use similar way to account for the illiquidity of the prices. So here in this case, this is the manager and he wants the true price change. We have the price of a property. So it went from 20 to 32 in 1 year. And here, this is the factor they use a lot. This is called the smoothing or the unsmoothing. When the market price is not liquid, then when you ask for the mark-to-market price, no market price, so you get a quote based on appraisal or estimation. So the price tend to not fluctuate as much as the actual market price if you need to sell. So the price is smoothed. This is one of the factors to unsmooth the price. It means any actual price change for the period, only 0.6 get transferred down to the observed price you see quoted. So in this case, I have a $12 increase that I see from the appraised price, and this $12 represent 0.6 of the actual price change. So if this person needs to know what the actual price change is, it will be $12 over 0.6, and so it's a $20 actual price change for the period, but only 0.6 got filtered down to the smoothed price. Okay, so that's using the formula to calculate. The other way to actually figure out what the answer would be if you know a $12 increase in price, $12 increase. When you look at A, B, and C, the actual price change is less than the observed price of 12. So that would mean A, B, and C would be probably improbable, right? Because I have a $1 price change, actual price change in the asset. My appraised price went up by, in this case, 6 or 12, twice or 3 times than the actual price change. It can't fluctuate that much, right? Because it's smoothed, observed less than the actual. So A, B, and D actually are improbable answer just by looking at the number amounts. Right? So this is C. Let me see. So this is the last one we'll do. This one is more deductive reasoning. I'll let you read through it first. So here we have way to hedge the risk of commodities. Here they're building on several things in the course. In the commodities section, there are many questions on the pricing and how to use futures or forward contracts to either hedge or profit. So in all of these, there are always two parties, right? One buying, one selling. When, let's say this is the farmer, this is, I guess you can call McDonald. And so the farmer have cows to sell to McDonald's. So here, whether it is a forward contract, futures contract, or options to hedge, you have a buyer and a seller. So in this case, from a contract perspective, the farmer is actually short whatever it is. Short the actual asset, short the futures, short the forward, etc. McDonald's is long. It's buying the pig or the cow. So in this case, I'm trying to figure out who it is, because if you got the wrong side, then a buy become a sell, right? So you have to make sure who you are in terms of the trade to figure out which one you have to pick. It can help you screen out many answers as well, right? So here, if I am looking at hedging, for hedging, it's a little bit different because you have to do the opposite of the actual situation to hedge, right? So make sure what you do should offset the actual risk of what it's trying to protect. And this is a commodity producer. So producer is the farmer, right? The farmer is the producer of the pork or the beef, so they have to sell the item or the commodity to whoever the user is, the McDonald's in this case. So I'm looking at our situation here. So I'm looking at the risk of commodity price risk, and it's for a debt. So two things to look at. In this case, I need to look at when the farmer sells the cow, who's getting the money and who's paying it. Farmer's getting the cash. So for the farmer, the cash it receives represent revenue to them. For McDonald's, when they buy the pork, it's a cost to them, right? So they pay cash, negative cash here, farmer positive cash. So for the farmer, since we're hedging, we have to know what the risk is. So for the farmer, the risk is the price go down, right? The commodity price go down, their revenue go down because they're receiving the money. So in this case, I want to buy or sell something so that if the commodity price go down, the hedge or the hedging price will go up. That's what I need to do. So this is what I'm focusing on. And so here, when I look at here, I can look at, in this case, buy or sell, call or put, options or futures. So here, let's screen out what's not probable. In this case, if you look at hedge accounting or regular hedging, when you sell options, it is never a hedge, right? Because when you sell options, you get the premium up front, but you always get the downside. So in this case, no matter what you sell, call option, put option, this one cannot give you any hedging protection, right? So A is out, and then I got B, C, and D. So here, I want to profit from the hedge when the price go down, right? So in this case, buying a call gives me profit when the price go up. So the call option won't work here. I need protection when the price go down. So here, either the put option will work because I'm buying long the put. Price go down. So if the price go down, this one gives me profit, which offsets my reduced revenue. So put is correct. Futures can work the same way, right? Because I can short a future. So when the future price go down, I profit, which offset my price reduction. Unfortunately, here it's a debt, right? So for debt, when you look at the debt payoff, it is asymmetric, right? For debt, it's the other way. For your debt holder, the payoff is actually like this, right? So when a company does well, you have your principal and interest back, and that's it. No upside as a debt holder. Company do well, you don't get more. But when a company do worse, then you pick up the loss because now the company is bankrupt and you are stuck with the company as a debt holder, right? So when you look at the payoff for debt, it's asymmetric, like your options payoff. So in this case, futures won't work as well because if I short a futures to hedge, when the price go down, I get the protection. But when price go up, I actually lose money from this futures, which I don't want. Right? So futures is okay when actually it's bad, but when price are good, you will lose money. So it's not a perfect hedge. It's workable. So the only option left would be C, which will be workable in our case. So these are ways we can reduce, deduce the answer just from looking at what's given without actually going through many studying here. In the actual exam, you see many of these. In the course, we'll focus on more difficult questions because that's where the value comes in. For this one, I'll leave it to you. This is on the convertible bond valuation. So it's one of the ways to value the convertible using the Black-Scholes model. It's just applying it to the convertible bonds, but it's looking at what input you use as the 5 input for the Black-Scholes formula. So here I'll let you go home and see what the answer might be. If you need, you can email Janet and she'll tell you what the answer would be. This is another one from level 2. In level 2, when you have, let's say I give you $1 million and you invest, you try to allocate, right? So you decide you will buy half stocks and have, let's say, hedge funds or AI. So you allocate your money. Most people do it by risk and return, right? For our level 2, we have one additional part, which is allocate by risk. So I'm using a risk level to allocate my investment other than the risk return, maximum return for the risk angle. It works pretty well, actually, real life. So here it's looking at, if I want to allocate by risk level, how do I calculate? This is a starting point, right? The value at risk is the risk measurement. So I'm trying to allocate based on these. Marginal and component val are, I have one asset out of 5 in my portfolio. How do I calculate those so I can balance and allocate properly using risk? Yeah. So this is in level 2. So here, if you have any questions, I'll be around. But let me let Jenna take over for this part.